If you're watching this on February 24th, 2026, you need to drop everything right now. Because what's happening in the precious metals market today could be the most important signal you've seen all year. The Shanghai market just reopened after the Lunar New Year shutdown, and I'm telling you, this is like flipping a giant switch on global silver and gold prices, and the shockwaves are already hitting portfolios around the world. Before we dive in, if you're serious about protecting your wealth in markets this wild, smash that subscribe button and hit the bell, because I drop this kind of deep analysis regularly, and you cannot afford to miss it. So, let's set the scene. China is the world's largest silver consumer on the planet. Not second, not third, number one. They're gobbling up billions of dollars in industrial demand every single quarter for solar panels, electric vehicles, and AI-powered data centers. When their markets go dark for Lunar New Year, the entire global silver ecosystem feels it. Prices got erratic during that holiday vacuum, dropping sharply because industrial demand grinds to an absolute halt. And here's something shocking. Silver suffered far worse than gold during this period, proving once again that silver's dual personality makes it the most volatile major commodity on Earth. Now, as of today, silver spot prices are sitting around $86 to $88 per ounce, after yesterday's highs of 88 to 89. But here's where it gets insane. The Shanghai Futures Exchange and the Shanghai Gold Exchange have cranked back up, and we're already seeing an initial 1% surge in local prices, followed by a brutal 3% pullback, all amid broader global weakness. Shocking alert, this isn't just noise. This is pent-up demand from the world's largest buyer clashing violently with global repositioning. And if you're not paying close attention right now, you are going to miss the next massive move. Let me break down the numbers for you, because they are jaw-dropping. The Shanghai silver premium right now is screaming at us. Spot silver in China is trading at a whopping $8.71 premium over COMEX and LBMA benchmarks. That's nearly 10% higher than what you and I are seeing in Western markets. Convert that to real numbers. While we're stuck at $86 to $88 globally, Shanghai is implying $95 to $97 per ounce locally. Why is this happening? Physical scarcity is hitting critical levels. Shanghai Gold Exchange inventories are depleting to multi-year lows around 800 tons. That's roughly 25 to 26 million ounces, down massively from 2020 peaks when inventories were far more comfortable. China's industrial machine is revving up for renewables and AI data centers, and there simply isn't enough silver to go around. Import restrictions, logistics delays, and a 13% VAT tax are bottlenecking supply so badly that local buyers are being forced to pay through the nose. This is a screaming bullish signal because it foreshadows enormous upward pressure on Western prices as arbitrage traders eventually bridge that gap. But here's where I want to raise the alarm, because this is where the concern gets real. COMEX registered silver inventories are sitting at just 82 to 88 million ounces. That is down 75% from 2020 levels. 75%. Think about that. You've got 223 million ounces of paper silver floating around in open interest on COMEX, backed by physical stocks that have been gutted by 3 quarters. That is not a stable system. That is a powder keg. Traders are already buzzing about potential market crashes or epic short squeezes, and with March futures approaching first notice day on February 27th, literally 3 days from now, the tension in this market is unlike anything we've seen in years. Now I need to walk you back to early February 2026, because what happened then is the key to understanding everything you're seeing today and what might be coming next. This is what I call the Shanghai flip, and it is the bombshell event that foreshadowed one of the wildest flash crashes in precious metals history. We're talking billions wiped out in hours. Gold nosediving from over $5,600 per ounce to under $5,000 intraday. And silver got absolutely obliterated. A staggering 26% single-day plunge, the biggest on record. Not the biggest in a decade, not the biggest since 2008, the biggest ever recorded. That's not volatility, folks. That's carnage. Here's how it all built up. Throughout late 2025 and into January 2026, the precious metals bull run was on absolute steroids. Geopolitical fireworks, US-Venezuela tensions, Greenland disputes, Washington-Tehran friction, all of that was fueling safe haven buying, while speculative mania pushed silver to eye-watering highs of $121 per ounce. Gold wasn't far behind, smashing all-time records above $5,626. China was the engine driving this whole machine. On the Shanghai Gold Exchange, gold premiums ballooned to positive $70 to $72 per ounce over Western benchmarks. For silver, it was even more extreme. Persistent $10 to $20 premiums amid industrial hoarding for solar, EVs, and electronics. SGE withdrawals hit 126 tons in January alone, draining inventories to multi-year lows. It looked bulletproof. China was building what appeared to be an unbreakable floor under global prices, pulling Western markets along for the ride. And then came the flip. Around February 1st to 2nd, right before the Lunar New Year shutdown, that massive premium vanished almost overnight and inverted to a discount. Gold on the SGE suddenly traded at -$12 to -$14 per ounce below LBMA and COMEX levels. That is a rare inversion after months of Shanghai leading the global rally. For silver, the dynamics were similar, but far more violent. SGE prices crashed harder, premiums flipped, and SHFE futures went into backwardation. What happened? Pure demand exhaustion, profit-taking after the rally, over-leveraged positions cracking under pressure, and reduced import incentives as prices had simply gotten too hot too fast. Add in China's own margin hikes. The SGE and SHFE jacked requirements multiple times to curb speculation. And the physical floor from Asia just evaporated. And here's the brutal deep analysis. The flip didn't happen in isolation. It crashed directly into Western paper markets, where COMEX open interest was towering at 223 million ounces of paper silver against those gutted physical stocks. When the world's biggest physical buyer tapped out, the paper market had nothing to hold it up. The cascade that followed was apocalyptic in speed. A hawkish Fed nod, a strengthening US dollar, margin calls triggering margin calls, and algo trading piling on sells at machine speed. On January 30th, gold suffered its steepest intraday drop since 1980, over 11 to 12%, erasing $700 in value during a single session. Silver cratered from $121 highs down to lows around $72 to $77 before any meaningful rebound. Implied volatility for silver exploded. The CVOL index hit 130 plus, while COMEX raised margin requirements to 9% for gold futures, triggering further liquidation cascades. Some Chinese silver funds had trading halted entirely to stem the bleeding. Billions in paper wealth gone in hours. Now, here's what makes this even more fascinating for traders. And this is why I call silver gold on steroids. Silver's market is tiny. At its smallest, it's been just 1/60th the size of the gold market. That means a relatively small trade can move silver prices dramatically. Historical beta shows silver moves 1.5 to 3 times gold's percentage in bull markets, but falls even sharper in bear conditions. During February alone, silver's daily price moves hit 4 to 9% routinely, with extremes touching 20 to 30% on the worst days, while gold was sticking to 1 to 3.5% swings. On February 19th alone, COMEX gold intraday ranges exceeded $63 in a single session. Silver's implied volatility spiked to 110 plus in early February versus gold's comparatively mild 30 to 45 range. This is why COT reports matter so much right now. Hedge funds have trimmed net longs to 3-month lows, which actually creates room for powerful reversals if Chinese demand ramps back up. And fast forward to today, February 24th, as Shanghai reopens, we're seeing that silver premium rebuild to $8.71, nearly 10% over global spot. Gold is sitting closer to parity with a flat to small $0 to $50 discount. No wild inversions yet, which is actually a stabilizing signal. The SGE has even tweaked margins downward, dropping silver contract requirements from 27% to 24% to ease the volatility and protect physical positions. These are the kinds of institutional moves that tell you the exchange is trying to stabilize, not accelerate the chaos. Big number alert. Combined SHFE and SGE silver stocks are scraping along at 800 plus tons, that 25 to 26 million ounce range, highlighting ongoing physical tightness that could spark another squeeze directly ahead of COMEX's March 1st notice day on the 27th. So what does all of this mean if you're trying to trade or invest in this environment? Let me walk you through the actual strategies, because this is where the rubber meets the road. The most powerful tool you have right now is premium monitoring, treating the Shanghai flip as your ultimate early warning system for peaks and reversals. When SGE premiums widen persistently beyond 5% for silver, that's your bullish green light. Physical scarcity in China, industrial demand sucking vaults dry, and COMEX registered stocks already down 75% from 2020. The setup for a squeeze is real. Action plan: buy on dips when premiums hit 5% or more, targeting upside toward $92 and beyond if momentum holds. But when premiums invert to a discount, like that negative $14 gold bomb in early February, that is your sell signal. Short futures or ETFs immediately, because it screams demand exhaustion and incoming deleveraging. Traders who shorted at the inversion in early February captured 11 to 12% gold drops in hours. The risk is false flips during holiday periods, creating temporary discounts. So always cross-check with SHFE volumes and COT positioning before pulling the trigger. For institutions or sophisticated traders, the arbitrage grind is another angle, exploiting east-west divergences for steady gains. Earlier this year, Shanghai silver was trading at $131 equivalents, while COMEX lagged at $114, creating more than $17 gaps. The current $8.71 premium, implying $95 to $97 in China versus $86 to $88 in the West, is still a meaningful spread. The problem is China's SHFE delivery restrictions. Zero allocation for non-hedgers end of February mean only approved industrial participants get physical metal. For retail traders, the proxy is ETFs like SLV or future spreads. Position long COMEX before Shanghai opens at 9 a.m. Beijing time, around midnight AEST, to capture that pent-up demand surge. But caution, CME margin requirements of 18% for silver can wipe leveraged ARB plays fast, as the 40% peak-to-trough silver whiteout proved. For options traders, volatility harvesting post-flip is where the real edge lies. Silver's COMEX C-vol spiked to 130 plus, pricing in plus or minus $4.80 per ounce daily swings. That's 99th percentile territory. After a discount flip signals bearish exhaustion, buy call spreads targeting quick rebounds. Think silver from the $72 to $77 lows back into the 80s as happened mid-February. When premiums rebuild fast post-crash like they are right now, sell put spreads for theta decay, betting on consolidation above key support at the $85 to $86 cluster. Track CME's G-vol index. Gold elevated at 42.5, Silver ranging 78 to 110 for relative plays. Pair trade long silver vol against short gold vol when divergences widen beyond historical norms. And for the long game stackers, the people who don't want to play with fire but want to benefit from this structural story, the fundamentals couldn't be clearer. Silver is now in its 6th consecutive year of structural deficit. 6 straight years. Up 23 to 24% year to date, despite a 15% monthly pullback. SGE stocks at multi-year lows. Chinese industrial demand growing for solar and AI infrastructure. And COMEX physical backing at 75% below 2020 levels. Accumulate physical on Western dips below $85 and hold for Eastern premiums to force global price uplift. Real stackers avoided the momentum traps at January's $121 highs and scaled in at the $72 to $77 retracement zone post-flip. That discipline is what separates wealth builders from bag holders. Here's the overall picture, folks. If the current physical tightness in Shanghai persists and pent-up Chinese demand comes roaring back, we could be looking at $92 as the next near-term target, with some analysts even putting $150 on the table if the structural deficit story accelerates. But if the US dollar strengthens further, tariffs bite harder, or another flip occurs signaling Chinese demand exhaustion, the $85 to $86 support cluster will be tested, and a breakdown there opens the door to significantly more pain. The bull case and the bear case are both live right now, which is exactly why this moment requires your sharpest attention. The Shanghai flip is now the most important barometer in precious metals trading. Watch those SGE premiums via en.sge.com.cn or aggregators like Metal Charts. Set alerts for 5% swings. Read the COT reports every Friday and watch what happens around February 27th's first notice day, because the paper versus physical tension on COMEX could produce fireworks in either direction that you do not want to be caught off guard by. The market is telling a story right now. Supply tightness, depleting inventories, a world's largest buyer back at the table, and a paper market sitting on a 75% depleted physical foundation. That story doesn't end quietly. Stay sharp, stay informed, and if you found this analysis valuable, please share this video with anyone navigating these markets. It genuinely could make a difference for them. I'm OG John AG, and I'll catch you in the next one.